All right, we got some people giving us a thumbs up. Great. All right, well, good morning, everyone. My name is Chris Lopez. I'm a real estate agent here with Your Castle Real Estate, and I do a lot of work with investors and house hackers. And today is part 3 of our 3-part series on building a 10-property rental portfolio. So the previous 2 webinars, we went through the software, the real estate financial planning software. And if you guys have not seen the first webinar, go back and watch it. It is worth an hour of your time. But in that scenario or that webinar, we did buying 10 rental properties at 20% down. The previous webinar, we did buying 10 properties at 5% down as a nomad. So that's as an owner occupant. Then you turn around, keep it as a rental. And then today we are looking at buying 10 properties at 5% down with house hacking involved, meaning you're buying these houses and you're renting out a couple of the extra bedrooms to tenants or your friends to bring in additional cash flow. So as I said, this is the part 3 of the webinar series. Now I'm putting up all the webinar recordings at denverinvestmentrealestate.com/REFP1. And they'll just be recording 1, recording 2, recording 3, all in one spot. So visit that link. The audio is also being posted to our podcast channel. So I've got Joe Massey with me here again, who is a senior loan officer at Castle & Gook. Good morning, Joe.
Good morning, Chris. I always appreciate being able to come on the podcast with you. Really excited to see what James has for us. I was blown away in scenario number 1 and then scenario number 2 last week. I know this is even going to be even more powerful. You know, house hacking is a very popular topic that I get a lot of questions about. And I think having this software to really supplement, here's what it is, here's what house hacking is, here's how it looks, and then here is your financial results over a period of 10, 15, 20, 30 years. I'm really excited to see what it's going to look like.
And of course, we have got James Orr, who is the creator of the real estate financial planning software. So James, welcome back.
Thank you for having me. I appreciate it.
All right. So I'm going to flip over to your screen because you are the man with the scenarios in your account. And as I switch over here, because we've had a lot of interesting discussions offline about different scenarios and then using nomad house hacking, comparing to different things. So just give us all the setup as to what's going on here and what this exactly means.
So yeah, I'm happy to. So the webinar 1, I guess 2 weeks ago now or so, we did a scenario where we walked through buying 10, 20% down payment properties. And I kind of walked you through all the details on how to set up the scenario, how to do all that. But then last week we went through and we changed up some of our assumptions and we assumed we were doing nomad. And nomad, for those of you that were not on last week's call, is buying a property as an owner occupant, moving into the property, living there for a year. And the reason we do that is, number 1, to get a lower down payment amount. You can do 5% down instead of 20% down. And then also you get an interest rate improvement when you're doing owner-occupant loans. So we did that. You move into the property, you live there for a year, and then you convert that previous property to a rental when you buy your next property. So it's a way to acquire 10 properties for essentially 2.5 down payments worth of 20% down. So for the same amount of money you could have bought 10, 20% down rentals, you can do that with 1/4 the number of down payments. And so this week we're going to pick up where we left off and say, we're going to do the same nomad process again, except this time we are going to allow us to get roommates to simulate house hacking. And there is a distinction in my mind between house hacking and nomad. Nomad is that sequential buying of properties where you move in, live there for a year, and then convert it to a rental. And house hacking is where you get income from properties you're living in. So it could be duplex, triplex, fourplex, or it could be getting roommates in the individual properties you own or something like that. So does that kind of help clear things up, Chris?
It does.
Okay. One thing I wanted to say before we get started here is that we're modeling house hacking, but house hacking, the way we model it, it's the same exact thing as if you decided to get a side hustle. So if you think about house hacking in this particular example, we're assuming you're getting 2 roommates, and I think we're assuming you're getting $600 per roommate for doing that. So that's really financially equivalent of you getting a $1,200 a month side hustle, whether you're deciding to do delivering pizzas or getting a second job or wholesaling or doing a side Amazon business or whatever you decide to do. 2 roommates at $1,200 a month total is the same as getting $1,200 a month total from income. And Joe, I'm kind of curious what your take on this as a lender. Is it the equivalent for you if someone has 2 roommates they're getting $1,200 a month for, as if they have a side hustle where they're getting $1,200 a month?
Kind of. So I'll try not to give you too long of an answer. When you're buying a property and you're going to have roommates, we're not going to give you credit for the 2 roommates right away, right? So you're buying a property and you're planning to have $1,200 in rental income. We basically consider that boarder income or roommate income. We're not going to give you credit for that when you're qualifying for the new loan. But then when you're going to move out and you're buying the next property, if you've been claiming that roommate income on your tax returns for the past year, 2 years, then yes, we're going to give you credit for that. So it's kind of, I guess, is the answer. If it's a brand new property, no. If it's a property you're moving out of and you've been claiming the income, then yes, we are going to give you that credit.
So what about like a side hustle, someone who has a side hustle for less than a tax year? Are you going to be able to count that as income, or does it really need to show up on their tax return?
Same thing. So a side hustle, any sort of part-time job, you have to have it for a minimum of 2 years in order for us to count that. So very similar, if it's something that you're just starting your side hustle, no, we're not going to be able to use that. And the reason behind that, a lot of people say, oh, well, I'm doing great, driving for Uber. Well, if you've only been doing it for 6 months, anybody can kind of hang on to have a second job for 6 months, but we're giving you a 30-year loan, and that's a long time. We need to see that you've made it through a couple of years of having your full-time job and that part-time job. So we really need to see that consistency is what we're looking for.
And
Awesome.
so I'm curious. I want to get some details here. Sorry, James. So I know a lot of times for rental income, when you purchase a property, you can claim like 75% of the rental income. There's different rules about that.
That's correct.
In the scenario with, if I have 2 roommates, I've been claiming my tax returns. I know if it's a side hustle, I can use 100% of my income.
Mm-hmm.
If I've got my 2 roommates, you and James are living with me, can I claim 100% of your income? And can you use it, or is it 75%?
No, we'll claim 100%.
Okay.
Well, 100% of whatever you're claiming, we're going to give you credit for that. But then you might have factored in expenses, so those are going to come off as well.
Gotcha. Okay.
Yep. Good question.
And the point I'm trying to make too about this is we're not necessarily using this to qualify from an income perspective. We are using it to gather more down payments so that you can acquire property swiftly.
Exactly right. I think that's a very good point.
Yeah, and so in both cases, you're really making an extra $1,200 a month, which goes a long way to you coming up with 5% or 10% or 20% down to acquire your next property. And you're going to see that impact today when we kind of go through these scenarios. So unless you guys have something else, I'm going to just run through quickly what the differences are between this scenario, the setup, and what was happening last week. And then I'll show you a bunch of charts. And I'd like to show you some charts we didn't see last week where we drill down into specific properties. Is that cool?
Sounds great.
Great.
Okay, good. So basically the same scenario setup, the scenario name doesn't matter. It's whatever you use. Number of months, we're still doing 40 years. We're not naming individual people. Same effective income tax rate that we used before. Same inflation rate of 3%. Same mortgage interest rate because it's still an owner-occupant loan where we're paying a one-time upfront PMI payment. And then we're same target monthly income in retirement. Same yearly safe withdrawal rate. This is just the description we use to keep track of things you want to kind of make notes to yourself about. Still doing 1 run for Monte Carlo. Same account. We're using all the money is getting deposited into that stock market account that's earning what we assume was the average for the VT SMX for over 1871 through 2017, which was 8.97%. So all that's the same. Same exact property that we had last week, same 5% down. So all the assumptions where we walked through last week's numbers are all exactly the same as this week. The difference here, though, is you'll notice we have an extra paycheck and personal expenses. So the normal paycheck and personal expense that we had previously was we were earning $5,000 a month, and we had $1,009.74 in personal expenses, not including your housing expense. You have the 23.11% tax rate, and we're depositing that money into the stock market account. However, there's a new paycheck and personal expense, and this one is the house hacking income and personal expense. So for this particular rule, and I'll drill down into it, basically it's it gets applied to this scenario. It goes into the stock market account. The money gets withdrawn from the stock market account, and you'll notice we have an additional paycheck of $1,200. That is 2 $600 a month roommates, or a $1,200 a month side hustle, or any combination of side hustles that in aggregate make $1,200 a month. So this could be, delivering pizzas and starting an Amazon business or something like that. Now you'll notice we don't have any additional personal expenses on this because we've covered those in the last paycheck and personal expense. This one is just an extra paycheck that you're getting. Your personal expenses are already coming out elsewhere. We are also saying that this is inflation adjusted. And so over time, the amount you're getting from your roommates goes up. And we are still saying you're paying the same tax rate on this money that's coming in, that 23.11%. So to kind of recap, all I really did is I added a second personal expense, a paycheck and personal expense rule to this scenario, and everything else is exactly the same. Does that make sense?
Yeah, this makes sense. I just want to clarify this because I know we got a lot of people that are starting to dive in the software. So if you're running a house hacking model, you don't include the income on the property. You basically just set up another paycheck rule, and that's how you count the income then.
That's how I do it, because it's really not separate rent while you're owner occupying the property. It's really like extra income you've got coming in from the business of having roommates. And so that's how I like to look at it. You could try to finagle the system and kind of do a below market rent or whatever the rent is for your roommates and try to set it up that way and then adjust the rent when you actually move out. Instead of doing that, I'm just saying you've got this nomad property and normally rent when you're living there is zero. But because we're going to say you have an extra paycheck coming in, it simulates you having roommates.
That makes sense.
Yep. And so that's exactly how we do it. Same goal as last time, which we'll go into. But without further delay, I'd like to jump in and start showing you some different charts.
Yeah, and while you're loading those up, if anyone out there has any questions, ask them. We are actively monitoring them, so please ask away.
Okay. And what I'd like to do is before we jump into a lot of the detailed charts, comparing the 2 or 3 different scenarios, because we can compare them all on one screen, what I'd like to do is show you the difference in how fast you can acquire the properties. Excuse me. And then show you some of the different properties based on the rentals we have. So one of the things I'm going to show you is the number of properties owned. And I will compare those to the other scenarios we ran here. I'll add some other scenarios to this chart and show you how they compare to the last couple scenarios we ran. Okay, so originally, this was our acquisition schedule for acquiring 10 rental properties with 20% down. This was the first class we did 2 weeks ago. And you can see it took us a little bit of time originally to be able to buy the first property. It looks like we bought the first property around month 1 or rather month 11. And then it took us until month 53 or so to buy the next one. And then it got faster, as Joe pointed out the last time, until you got to the point where you had 10 rental properties total. And then we were living in someone else's rental as a renter ourselves. Okay, so you had 10 rental properties and you did that. That was our original scenario. Last week, though, we talked about only putting 5% down and being able to buy the first property initially in month 1. And then every 12 months thereafter, it looks like we're buying a property. Now, it may not have been exactly 12 months because we may not have had enough money to buy the property 12 months to the day after we were able to do it. So it shows you, though, you acquired it much quicker than the 10, 20% down rentals. Now, let's see what difference it makes when we do house hacking and we have an extra $1,200 a month coming in. This is super interesting. So you can see the difference. I'm going to turn off the 20% rentals, and I'm going to look at the difference here between these two. And you can see the ones where we have a little bit extra money coming in from roommates, we're able to buy some properties faster. So the first property we bought, the exact same speed. The second property we bought, same speed. Third property we bought them at the same time. The fourth one we bought, same time. However, by the time you get to the fifth property, you're able to buy the property, it looks like, 1 month faster by having these roommates. And that's really a function of being able to save up for the down payment to be able to buy those. So you bought the property about 1 month faster here. And then it looks like, 3 months or so faster for the property number 6. And then a few months faster for 7, a few months faster for 8, a few months faster for 9. And then finally, the 10th property, you're able to buy that a few months faster. Can you see what I'm talking about on that screen?
Yeah, it's coming through and it looks really good. And I guess this is really interesting to look at. So I guess as far as the buying the properties, the biggest limit is that you got that 1 year owner occupant rule is probably the thing that's slowing it down the most with the extra income.
Yes, I think that's true.
Mm-hmm. That makes sense.
Yeah, because you have a 12-month hard-coded limit as to when you could buy your next owner-occupant property. Because when you get your loan with the lender is going to ask you to sign a form that says you agree to occupy this property as an owner-occupant for at least a year. And so by signing that, you cannot go and buy another owner-occupant property without some unusual exceptions like moving more than 100 miles outside the area or, divorce or something like that, some type of like life event that causes you to be able to do that, which I'm sure Joe can talk to you about. But otherwise, you have this 1 year limit that you cannot go buy another owner-occupant property for. Okay, so I just want to show you that. Now, what I'd like to do is turn off these other ones, and I'm going to go and drill down to some of the properties so you can see those. Because we didn't do this in the previous ones at all, but these show you the owned properties that we have, and this allows us to drill down and see, information about all the different properties we have here. So, for example, I'll just pull up the first chart, which is appreciation. This chart shows you how much appreciation each house individually is giving you each year, or each month, rather. And so it's showing all 10 properties. You can go and decide to turn on or off any given one, but I have all of them showing here. And so if we just turn off some of these other ones temporarily on the chart, you can then see the first property you bought and how much the property is appreciating each month. And we're assuming a 3% per year appreciation rate. So if we kind of zoom in here a little bit, you can see in month one, when we buy the first property, the property value went up $739.88 in that first month. And then the next month, it went up a little bit more because you have compounding on top of the previous value. So it's $741.71 there. And you can see it over time that it continues to grow so that by the time you're at year 40, that property value is going up like $2,400 per month. If we adjust for inflation, you could see it's about the same. So if we adjust for inflation now, it's $739 or so. And by the time you get to the end, it's still about $739. So that same 3% growth rate, since inflation is also 3%, it means that it's really going up in the same inflation-adjusted dollars in month one as it is in month 480. That make sense?
Yeah, it does.
Mm-hmm.
Okay. So how did you get to this chart? I'm sorry, this is just what you clicked on.
Yeah, so right here it shows you scenario charts, which shows you charts for the whole scenario summarized. There's charts for different accounts. And so we can go look at, account balance and stuff like that. And it shows you things for that. And then there's another one down here, which is for owned properties. And so that shows you all the different ones for owned properties there. And there's another tab for goals. So this shows you basically appreciation numbers for that. And this is the inflation adjusted one. Now,
I missed all those previously, so that's great to know.
Yeah. And you could drill down and see basically the scenario as a whole, accounts in detail. You can go, if you have multiple accounts you're running, you want to look at each one of those, and then multiple properties in detail. So that's what this really allows you to do. So this shows you each individual property's appreciation. If you wanted to, we talked about this, I think, on day one, but you can actually stack how much appreciation is happening for all the different properties. So you click on the stacking button, and what this does is instead of showing you all side by side and overlapping the charts, it adds them graphically on top of each other. And so I'll zoom in so you can see what's happening. This was the appreciation on one property. And if you go to this month where we add the second property, it just adds it to the top of the chart to show you what the total amount. So for example, these two properties combined are appreciating at $1,524.16 per month. So $1,500 and change. Does that make sense?
That's cool.
Yeah, that is a cool graph.
We were just sitting here giggling and looking at this. I'm like, this is exactly what people want to see. That's very cool.
Yeah, and there's a whole bunch of really interesting ones that you can look at. So, I mean, appreciation rate is boring because it shows you that all the properties are appreciating at the same rate. But you might want to go and model what happens if certain properties in certain parts of town are going to appreciate at different rates. So you might buy a property in, I don't know, name a part of Denver, Lodo. Do you guys have like that type of area for you? Yeah, so that property might appreciate faster than a property in, Old Aurora. And so you might decide to say, the properties in Old Aurora are appreciating at 3%, the ones in Lodo are appreciating at 4%, and you can apply different appreciation rates and see where it is over time. Or you might say, hey, listen, this area I think is going to be growing for the next 5 years, and then it's going to stabilize and be normal. You can change the appreciation rate and say, this will appreciate really fast at 4% or 5% or 6% for the next 3 years, and then it's going to taper off and it's going to be at a 3% consistent for the next 40. Okay, so it allows you to go and do that with rules, and you could see what the different appreciation rates over time are for each one of those. Make sense?
Yes, it does.
Yeah, and so there's a couple other interesting ones, like break-even ratio shows you like what your break-even ratio is for each individual property. Break-even rent, so it'll calculate how much rent you need to be earning in order for it to be break-even. And you can see here that when you pay off loans eventually, turn these other ones off temporarily here, you can see that your break-even rent ratio goes way down because you no longer have a mortgage payment here at all. And so you can see that visually.
And that would just be covering the expenses.
Taxes and insurance, basically.
Yep, basically taxes and insurance on the property. Yeah. So you can go do that. You could see what CapEx appreciation rates are, what the actual capital expenditures are if we had those. Remember, our assumption is that we rolled those into maintenance on this particular one. Here's another interesting one. You guys like cap rate, right?
Mm-hmm.
Yeah.
And so one of the interesting things you could see about cap rate on this property is originally, when you buy the property and you're living in it, you don't have any income coming in from it. So your net operating income on the property is negative. But then over time, your cap rate jumps up when you start renting it out. And this one, we assumed it's about 5.79 once you start renting it out. But you'll also notice that cap rate is increasing over time because the rent on the property, your net operating income is increasing over that purchase price that you have there. And so it's increasing over time as you do this. So the longer you hold the property, depending on what your assumptions are, the more likely you are to increase what your cap rate is on that property. Now, if you were to go rebuy it, not the same, right? Because your purchase price then changes. So this
as this calculates it, it's always using the original purchase price, not the appreciated price, right?
That's right. Yep. So it shows you that
makes sense because rents generally go up, right? So
That's
it makes
right.
sense that rents exceed a little bit. Rents go up a little bit more than inflation. So that makes a lot of sense.
Yeah, and the other thing about it too is your expenses on your property, since they're a small part of it, while they're still going up with inflation, because we're assuming they're going up at the same rate, they're not going up faster than your income is on the property because it's a bigger number.
Yep. And the mortgage is fixed. That mortgage payment is inflation protected, as I like to say. That principal and interest doesn't increase.
Totally. And we see that when we do cash on cash. We won't see that in cap rate because remember, cap rate does not take into account any mortgage payment. So like if we jump down here and we look at the cash on cash return on investment, we can see a very similar thing happen. You have, I'll turn off some other ones just to make it a little clearer, but we could drill down into any one of these properties and see them. So early on for cash on cash, you're living in the property. So your cash on cash return is really negative. Then when we actually start renting it, it's a little bit negative. And we talked about this last time, is that because you're not putting 20% down where this property would be break even, you're putting 5% down and you're financing 15% of your down payments, then you're going to have negative cash flow on this property until your rent increases enough so that it's positive here. It looks like month 49 or so by the time you get a positive cash on cash return. And then over time, though, it increases a lot until finally you pay off the mortgage and it increases there. And you can see that.
So I've got kind of just an odd question for you. But in that first year, we're like a negative 100% cash on cash return.
Yep.
That's not actually taking into account your house hacking income or your side hustle income, right? Because that's calculated through your paycheck.
That's right. It's basically not taking that into account in there because we're assuming you're not renting the property out, even though in this case you are. Yep.
Yeah.
So that's one of them. You can look at individual cash flow on all the properties, so you can see this over time. Show you that.
James, I gotta tell you, man, like I didn't even know all these other charts were in there. I totally missed that menu below there, man. This is like just so much cooler now,
right?
Yeah, I mean,
I feel like I'm in a candy store, you know?
Yeah, sometimes, like when you're buying different properties, not just the same property over a time where they all look very similar, sometimes you notice some very odd things happening with a particular property, and you want to drill down and see why is this property acting so oddly, and it could be just your assumptions about something, or it turns out it's not as good of investment over a longer period of time as you thought when you first bought it. And you could see that by drilling down into an individual property. So so same thing here, just shows you kind of like the cash flow, negative cash flow up front when you're living in the property. Then it's still slightly negative while you're financing your down payment. Then eventually it increases. So you can look at cash flow. You can look at cash flow from after CapEx if you include that. This cash flow from depreciation is super interesting because you basically can calculate how much cash flow you're getting by depreciating the property over time. And that's taking the depreciation benefit and multiplying it by that effective tax rate you had entered in on your scenario. And so you can see how much your cash flow from depreciation is. And of course, you don't get any while you're living in the property, although with roommates, you would get a little depreciation benefit. You could depreciate that percentage of the property that is rented out, not the whole thing. So you'd get a partial depreciation benefit technically by having roommates. But once you get full rented out property, then you're getting this full cash flow from depreciation benefit over time. And it shows you what that is. And you'll notice that it's fixed. Why doesn't this one increase with appreciation or kind of inflation?
Because it's based on the purchase price divided by the 27.5-year depreciation schedule.
That's right. It's basically the purchase price minus the cost of the land, because we can only depreciate the building, and then we divide by 27.5 years for residential properties, and that is a fixed number. It does not increase over time. And an interesting thing, if you decide you want to sell your properties, is you do have depreciation recapture, which kind of like the government rewards you while you're owning the property to depreciate it, but it does get it back when you go to sell the property. So if you're selling properties, this is a temporary short-term benefit you're getting, and you'll pay 25% depreciation recapture tax on this when you get it, when you actually go to sell the property and they do it, unless you do a 1031 exchange or something else creative. Let's see here. So we talked about that. Cash on cash return. I think I showed you that one. We talked about this cash out refi equity before, and you can kind of see each individual property's contribution to your cash out refinance. So you can see originally here it's negative because you don't have enough to hit the 75% of the property value, which is usually the threshold, Joe, I believe, for your cash out refi, 75%.
For investment property, you're exactly right. Yep.
Yeah. And so right here, it basically shows you that if it's this 75% of the value minus the mortgage balance. So you wouldn't do a cash out refi on this one until it got to this point. And even then, while it's really, really small, it's not likely that you're going to do a cash out refi to access 5K. You could, but you're probably not going to do that. And so you can go ahead and do that. If you want to see the accessible one, I guess I don't have it here on this chart. We have the accessible ones on the scenario summary where it only shows you ones where the cash out refi is positive. Looks like closing costs. You can see what the closing costs are at each individual time. Looks like it's about, this case, 2.85% for this property. And it shows you when they happen for that. Let's see, cumulative cash flow. This sums up the cash flow for each of the properties over time. You can see this last one that you bought, because you're continuing to live in it, it never has that positive cash flow. So you're continuing to deplete your account balance for that particular one right there. But the other one, the last one you do, actually gets cash flow over time. All right, let's see here. Yeah, I mean, there's so many charts here. You could drill down into almost anything you want. True cash flow, your utilities, your vacancy, seller concessions, rent-ready costs, how much you're getting for rents, property values, property taxes over time, property insurance, property management, other income or expenses on the property, operating ratio, the number of months you have a property rented, the number of months remaining on the mortgage, which is an interesting one to look at because you can see those decline over time. Especially when you're paying off mortgages early, one of the rules you could set up is to decide I'm going to, test paying off mortgages early. You can see these charts where the remaining months of the mortgage really declines. Mortgage balance and interest rates. You could see kind of like all those different things, net operating income. So you can kind of get a feel for any individual property's details. So do you have any questions on this before I kind of move over and start comparing this one to the previous two scenarios we did? Anyone have any questions?
I just want to see the debt coverage service ratio graph. I'm curious what that looks like on Nomad properties.
And I'm going to have a question too, but let's look at this one first.
Yeah. So there's debt service coverage ratio. And this is, I'll just pull up the first property so you can kind of see that. So originally it looks like it's negative 0.19. And then once you finally get it rented out, it's 0.93.
Yep. So you're losing just a little bit of money on that, which tied in with the cash on cash return chart. So it makes sense.
And what do you like to see, Joe, on your stuff? You see like the 1.25 or something like that?
Yeah, 1.25. But really for us, because we do residential finance, we really take a global look at it. So if you've got a property that's losing money, I don't really care as long as you've got money coming in from somewhere else, whether it's your side hustle, whether it's your primary job, whether it's your other rentals. So I don't really look at it on a property by property basis. That's much more of a commercial lender that would do that. So we're really looking at you globally. So even in this case, we'd be okay to give you a loan on it if you've got income coming in from another source.
That's all debt to income for you then, right?
Debt to income. Yeah, we don't look at it property specific.
Yeah.
James, you brought up a question for me when you were showing the charts showing the mortgage pay down.
Yep.
Is there a scenario or is there a way that we could show once we've acquired all of our properties? So I know like the first 10 or 12 years, we're saving up money to start acquiring properties. After we've gotten to 10, can we show the cash flow being applied towards the mortgage principal and how quickly we get all the properties paid off?
Totally. Yeah, I do that calculation all the time. So it's a new rule. Just basically create a new rule doing that. And if you save that question, if we have a little bit of time at the end, I will go ahead and just set up that rule and show you how easy it is to do, because it is super, super easy to do.
Awesome.
And then I could do it. And if we have time, I could even run it and show you the results. But yeah, it definitely is. In fact, why don't we do this? Because it runs in the background, why don't I go do the rule quick and then I'll run it and we can go look at it. Does that seem fair?
That sounds great.
I like that answer a lot.
Okay, so we basically are taking the same scenario we have, this 5% down payment Nomad Properties house hacking. I'm going to make a copy of the entire scenario. I'm going to just change the name to, say, with debt pay down. Okay, and that's how I'll know that it's slightly different. And I'm going to keep everything else exactly the same. I'm not going to modify anything that we did. And all I'm going to do is add an extra rule. And so the rules are pay down loans with cash flow. I add that new rule in here. I'll make it run for the entire scenario. I'm only going to apply it to the one with debt pay down. I will apply it from that stock market account. And what I'm going to do is I'm going to say, we want to keep a healthy cash reserve. And so I'm going to say, hey, we need to have at least $15,000 in cash reserve in our account. And I'm going to make sure that that adjusts for inflation over time. But anything over $15,000 in that stock market account, then I'm actually going to pay off loans. And I'm going to do the highest interest rate first. So you can choose which order you want to do if you want to test it. And so all
what are the options you have there? Oh, sorry.
Yeah, no worries.
On that drop
you can do lowest balance, highest balance, lowest interest rate, or highest interest rate. So really it's a function of whether you look at balances or interest rates and you do highest or lowest first. Okay. So actually, why don't we do this? Why don't we do lowest balance first? Because it'll take the smallest balance one and pay them off, especially since in this case, all of them have the same interest rate. And then I'm going to run the analysis. And so this is queued to run. I'll let it run. I'll take like 5 minutes or so to run. And then we'll come back through and we can check that chart and see what happens and even compare them.
Cool.
Okay.
Yeah, thanks.
Yeah, you're welcome. So go back to here. If you wanted to, you can look at individual charts. You could see how much the return was from your stock market account each month. And you can drill down and either look at the cash accounts or the stock market account. And if you have a whole bunch of different accounts, this becomes pretty interesting seeing which one has which. But in this case, since you really only have one account, it looks very similar to the summary stuff we had on the scenarios. Okay. So I'm going to go back to scenarios and I'm going to add in, let's look at net worth quickly. And I'm going to add back in those other ones we were doing. So 20% down payment rentals, add that one back. And I'll also compare it to the 5% nomads. So net worth wise, it looks like with 20% down, the 20% down rentals in month 480, and actually I'll just jump to month 480. We'll just take a look at it here. So with the 20% down rentals, it looks like we ended up with about $21 million in net worth by doing that model, buying 20% down payment rentals as soon as we have enough down payment to do it, as quickly as possible, and then investing the rest in the stock market. And then if we just do regular nomads, it's 31.2 million. That's 10 nomad properties where we do that. And then if you do nomad and you keep roommates or a side hustle for that entire period of time, it's about $5 million, almost $5.5 million more. So $36.8 million total. If we adjust for inflation, you could see that it's 11.3 million to 9.6 to 6.5. And that shows you the net worth comparison of all three of these.
This kind of makes me want to get a roommate. Chris, do you want to move in with me?
Or a side hustle, right?
What's the rent cost?
About
$1,200.
Yeah, $1,200.
And you can have two rooms.
Yeah, you can have two rooms. Exactly. This is cool stuff, James. I love it.
Yeah. And the other one that I like to look at is this total true cash flow, which takes into account that depreciation benefit and everything. And I'll look at all of them as well. And so you can see cash flow over time. If we zoom in early on, the ones with 20% down payment rentals, they had more cash flow, which you'd expect to be true. You put full 20% down and you're able to do that. But the other properties, they still have slightly positive cash flow early on if you include the depreciation benefit. Remember, it's negative if you don't take into account depreciation, the cash flow from depreciation, but you are positive when you take into account the cash flow from depreciation on those as well. And so over time, though, they increase. Looks like here, your cash flow from the Nomad properties exceeds the amount of cash flow you're getting from the 20% down. When you acquire your next one, it kind of bumps up. But over time, your cash flow really pulls away on those Nomad properties until looks like, I don't know, somewhere in this period here, 30 years or so in, maybe 29 years or so in, where your cash flow from the 20% seems to kind of overtake it temporarily, and then cash flow from the other properties just crushes it. So your cash flow for Nomad seems to be better for most of the period of time than the 20% down payment rentals, which is counterintuitive for, I think, a lot of people.
And so that's even considering the fact that really in those two Nomad scenarios, you only have 9 rental properties because you're living in the 10th one.
That's right.
Where in the 20% down scenarios, you've got 20 rental properties.
Yeah.
I'm still surprised. So even with essentially 9 rental properties at the 5% down, in the long term, that's actually better cash flow than 10, 20% down properties.
Yeah. And you know why?
I'm having a hard time wrapping my head around this. No, I don't.
It's by when you acquire them. Acquiring properties faster makes a huge difference because you're buying properties earlier, and you're letting your fixed mortgage payment, your principal and interest part of your payment. Of course, taxes and insurance are going up, but that mortgage payment gets fixed in time, and so you are no longer subject to inflation on that mortgage payment, and rents do go up with inflation. And so you're letting your rents increase over time while you have this fixed mortgage payment, and you're doing it way earlier in the process.
I need to save a screenshot of this, James, because I get into discussions all the time with house hackers about buying a property at 5% down, and it's going to negative cash flow probably the first 1 or 2 or 3 years that they move out. And that graph sums up, hey, in the big picture, as long as you can financially handle the negative cash flow, you come out so far ahead.
Yeah. And you're really not even having to handle it. As we show here, when you zoom in, your depreciation benefit offsets it so that as long as you're able to handle a positive $68.90 a month when you take into account the tax benefits, you're really positive. Sure, it is negative if you do the full calculation before tax benefits, but after the cash flow from depreciation, it's actually positive. So, yeah, it's definitely pretty interesting.
Do you mind zooming out on that graph one more time, James? There's something exactly what Chris said that is now clicking for me that hopefully the viewers are putting together as well. So if you look over on the right, your cash flow is increasing so much faster on the Nomad scenario after month 360 or so.
Yeah.
And it's remaining fairly steady when you've been putting 20% down. And what you said, James, just clicked for me. You're buying the properties faster in the Nomad scenario. You're also Nomad and house hacking scenario. Then you're also paying them off faster. Because if I got a property in year 1, I'm paying it off in year 31. I got a property in year 2, paying it off in year 32. Whereas when I'm putting 20% down, I'm not buying my second property till year 4. I'm paying it off in year 34. My third property is in year 8. I'm paying it off in year 38. So such a cool representation that wealth can be built so much faster with leverage, putting less money down today and just holding the property.
Yeah, and I'll show you a different one, I think. Yeah, I know. Total. Let's see here. Do I have total mortgage balance? Maybe I don't. You do a search on the page for mortgage balance. Mortgage interest rates, mortgage monthly payments. Yeah, I probably should add that one in there too, but I was going to show you the total mortgage balance, but this is a close one. It shows you your total mortgage payments of rentals. And the 20% down one, you could see that your mortgage payments are really high because you waited longer to buy them, where these ones, they start declining earlier. So your mortgage payments are going down faster. By the time you get to even before month 40, you've completely paid off all of your properties. whereas you're not
Right.
even paid off all your properties by year 40 with the 20% down ones.
Yeah,
So-
you only have 4 of them paid off.
Right.
So those 20% down ones, it's a much higher, even though you're putting more down, it's a higher total monthly mortgage because you're buying them later. So it's a appreciated price in the future and the higher interest rate, right?
That's right. Yeah, it's very counterintuitive because you are waiting longer, so you're buying more expensive properties. And even though you're putting 20% down, that ends up hurting you.
This is such a good illustration of what I say anecdotally all the time. Chris, do you know the best time to buy a property?
Yesterday,
Yesterday. Do you know the second best time?
today.
Today. And this is a perfect representation of that. Really, really good stuff, James.
Yeah.
I think you might have to move into my house, Joe, and be a roommate now after seeing this. You need to draw straws.
Yeah.
That's pretty awesome.
Except
Yes, you could see those.
Okay.
Let's see here. The total accessible cash out refi. I mean, we kind of look at those, but not really crazy. Total equity. You can see your equity in these grows a lot faster too because you're buying the properties much sooner. So the equity you have, even though you put larger down payments, the equity you have in the 5% down Nomad properties is more because you bought them earlier again. It's that same rule. You can see the green line versus the blue and red for the 5% down Nomads. So it's pretty big.
I'm curious, James. Totally off the wall question here.
Yeah.
Because Denver's a market that historically it appreciates,
Mhm.
and certain markets in the U.S. they don't appreciate. Have you ever run scenarios in some of those other markets that don't appreciate or sometimes don't keep up with inflation on appreciation, and what the difference is on Nomad versus 20% down properties out in the big picture like this?
I haven't personally run them, but it's super easy
Yeah.
for you to do it. Just copy it to
Yeah.
your account and change the appreciation rate in the rentals to be 2 or 1 or 0 or whatever you believe is to be true. So that's what's
I'm gonna
great
have to
about
do
this
that.
calculator. And as I just showed you a second ago,
question. Oh, sorry.
yeah, as I just showed you a second ago, it's super easy to just like modify this stuff. I made a copy of the scenario in my account, at least. You could have just copied one back into there, and then I just added a rule. You could just copy it in there and then just change the appreciation rate in one spot, rerun it, and see the results. And so it's super easy to do that.
Because I get all the time people, people debate, oh, should I invest in Denver because it's gotten expensive, or should I go out of state? And we've always had these discussions, but we've never been able to really model anything. Yeah, this could be so super cool.
Yeah, once we get a few of these like models plugged in, this is going to be great for myself and Lon to answer questions of should I invest somewhere else? Here you go. Here's Wichita, Kansas, and here's Denver. Which one do you like?
Yeah.
This is cool.
Yeah, and this shows you the same idea, total monthly rents. Your monthly rents and this doesn't include the house hacking part of it, but you can see the monthly rents for the 20% down takes a while to catch up. And then eventually your monthly rents are higher because you have that extra rental property that you pointed out, Chris. You basically have 10 rentals versus 9 with the Nomad model. And that's the difference between these at some point. But for a long time, you have more cash flow. You have more total monthly rents coming in from the Nomad ones because you acquired them earlier. So that's the monthly rent numbers. And the other interesting one is total saved. So you'll notice the lines are 3 different ones because you're saving with the green 20% down one. You're not living in a property, so your rent is actually increasing and you're subject to inflation from rent. So your savings rate is suppressed. With the one where you're doing the 5% down Nomad properties, your savings rate is a little bit higher because you're not subject to inflation on the rent of the property you're living in because you've got fixed mortgage payment on that one. And then eventually you pay it off. And so you're able to save a lot more at this very end point. But the other one, the blue line, is where you're doing house hacking and you've got an extra $1,200 a month that you're able to save. And that shows you your savings rate with that. And again, because you're nomading, you pay off the mortgage and that continues to increase. The other thing that you may want to run is you may decide I only want to get that extra $1,200 a month for like the next 5 years. I'm willing to suck it up and have a roommate for 5 years, but after that, no more roommates. And so you could go ahead and just modify that rule. Instead of running for the entire scenario, you just have it run for 60 months or whatever the date you want to stop is. And then that rule will automatically turn itself off at that point, and you can let the rest of the system run to see how much of an impact that has.
I see this turning into like that scenario and that rule turning into like a negotiation tool between a husband and wife, which is oftentimes
Yeah.
the husband's going home, the wife is like, no, what's the compromise here?
Right.
I could totally see some negotiations happening on here.
Yeah, I can as well. That's actually pretty funny. So that's pretty much what I wanted to show you as far as a scenario, unless somebody wanted to see something in particular. What I'd like to do next is go to the goal chart and show you how quickly each one of these three scenarios is toward achieving your kind of like target monthly income in retirement. So is there anything else people wanted to see before we jumped over to goals?
I mean, I want to see everything, but I will do that on my own time.
Yeah.
I don't have any initial questions right now. No.
Okay. And, as people know, they can copy this scenario into their own account, and then they could take all the time they want to drill into anything that they want to see. So that's super easy to do as well. You just have to copy it using that link that you gave out in the last one. Although you'll need the new ID number for this one, which I can give to you.
Yeah. We'll get that and post that here in a couple of minutes.
Okay. So here are the goals, and I'll shut off the other two new ones. So if shut off the wrong one. So if we're doing 10%, 20% down rentals, basically it looks like you're crossing the 100% goal line of achieving your goal around 259 or so. So what is that, 22 years or something like that? Somewhere around there if you do that. Last week,
and what's our goal for this? How much cash flow?
Getting 100% of your goal, which is $4,000 a month adjusted for inflation. So 20 years from now, it's more than $4,000 a month, but it's $4,000 a month from either 3.25% of your stock market balance per year and any positive cash flow you have from your rental properties. So cash flow from rentals counts, as does 3.25% your safe withdrawal rate from anything you have invested in that stock market account. Both those contribute toward achieving this goal. Okay, so that's the 20% down rental. If we look at the Nomad one happened a lot sooner. Basically, by the time you get to 100%, you're only at 44.75% toward achieving your goal if you had done the 20% down rental properties. So you're way ahead by doing the Nomad one. And then if you're willing to get roommates, it's even faster. So by the time you're able to retire with roommates, right about here or so, let me zoom in. Right here, so you're at 106% of your goal with roommates, and you're at 83% of your goal if you just did regular Nomad, or 37.7% of your goal if you had done the 20% down rental properties. So you can see how quickly you're able to achieve your goal there by looking at those. And then also, if you just want to see the numbers for when you finally hit 100, down here at the bottom is a table showing you which one's the fastest and then what the month is that you first achieved 100% of your goal. So it's 181 months for the roommate one, house hacking, 196 for just doing Nomad, and 260 months for doing 20% down, 10 rental properties.
I mean, I'm just looking at these numbers, and I mean, these are very realistic scenarios that we run here with numbers and, fairly ballpark realistic. And we're looking at 15 years, 16 years if you're Nomad house hacking. We're looking at like 22 years for 20% down. And to me, that still seems so quick because I grew up in the financial planning world where it's all just, hey, put 10% of your paycheck away into a 401k. And even by 40 years out, you may have enough money to retire one day still. It's very questionable. And this just dramatically cuts the time in half. And this is doing nothing fancy, nothing creative. This is all just very like, I'll say, I don't want to say boring. I'll just say like plain vanilla. Hey, if you just do this and you're willing to just kind of follow this very simple model, have a little sacrifice, I mean, you can be retired 15 to 20 years from now.
Yeah. And the nice thing about the software, in my opinion, is you could go in and say, hey, what if I can't get my spouse to go along with buying 10 properties and moving 10 times? No problem. Just go ahead and change the rule. Instead of having it max out at 10 properties, bump it back to 8 or 7 or 6 or 5 or whatever it is, and then rerun it and see where it actually achieves your goal doing that. And then you can go to your spouse and say, would you rather retire in 19 years or would you rather retire in 14 years? These are the two different options. Which would you prefer? And you allow them to make that decision.
Are you able to stack rules on top of this? So say, hey, my wife and I will buy 5 house hacking properties. Then when we achieve those 5 house hacking properties, run rule number 2 where we buy 20% down. Are you able to stack rules like that?
Yeah, you sure can. Yeah, it's pretty easy to do. So you could just basically say, I'm going to buy 5 house hacking properties with a house hacking rule. And then as soon as you get to that rule stops working. And then you can have another rule that says buy 20% down properties and just have the amount of cash you need to keep in reserve slightly higher for the 20% one, so it doesn't get triggered until after the other one happens. So that's an easy way to do that. So sure.
How do you trigger it? Is it just basically like putting them in sequential order, or just the total down payment amount?
No, it's not even a total down payment amount. The way that I would set that one up is I would say I want to have $5,000 or $10,000 in cash reserves when I'm buying the Nomad ones. And then for the 20% down ones, I want to have $15,000 in cash reserves. So it'll buy the Nomad ones first because it's going to hit that rule first. The other one won't actually get triggered until you have stopped buying the 5% down ones and your account balance has grown up so that it's got the $15,000 cash reserves plus 20% down plus your closing costs. So it really won't even start triggering at all until after you've triggered all the other rules.
Perfect. That makes sense.
Yeah.
So I do know I want to make sure we loop back around to Joe's question.
Yeah, let's do that.
About the scenario you ran. And Jim had asked a question right after you started running it. And that was for when you set up that rule in the stock market account. Is the $15,000 reserve for each property or the total account balance?
It's total account balance. Yep. It is not per property. So it just says I need to have $15,000, adjust that for inflation. So the farther out in time you get, the higher it is. Make sure I have that plus the down payment for whatever the buying that property is, plus the closing costs. And so if I have that amount of money, then great, I can buy a house. I do buy a house. It does that. It adjusts all the numbers and does it. And then it continues to run. And if you get that amount again, then it does another one. So, all right, so we did it. Here it is. This is the with debt pay down one. You can see that is the worst performing of the 3. And I will tell you the reason why I believe that to be true is because you are taking money that you are earning 8.97% in the stock market with, and you are voluntarily paying off 5.125 or 5.75% money by paying down your loans. So you're voluntarily getting a 5.75% on any excess cash you have instead of keeping it growing at that 8.97% in the stock market.
So it's the difference, and that's the lost opportunity cost.
Yep. So that's the difference in net worth. Now, what happens with cash flow? Because it may change cash flow very differently than it does a net worth number. So let's take a look at total true cash flow and see. So here's something interesting. Your cash flow actually tends to improve by the time you get to month, whatever this is, year 20 or so. The yellow line bumps up when you pay off one of these houses a little bit earlier. In fact, let's see here. This is debt pay down. It's showing that you're paying off these houses early, and it shouldn't be. It's total true cash flow. Let's drill down and take a look at this. This is why we don't do this on the fly. Let's see here. So let's see about when we bought properties and make sure that it's buying properties as we expected. Okay, so we've got a problem here. So basically, this is saying that we're starting to pay off the house before we go and buy the next house here. So it's being delayed in buying the houses. So we can adjust this rule again and not do it until after we bought our houses. So if we were going to do this, really, we wouldn't start this rule until after here, which is when we're acquiring properties, or month 118. So I'm going to go ahead and readjust that and say, don't start this rule until after month 118.
That makes sense. Yeah, because you were paying down your excess cash flow, so it took longer to save up and buy the next property.
Yep. So basically, whenever we had $15,000 in the account, which was triggering before other ones, because we basically the amount, this rule gets triggered before we bought the other houses. So I'm going to go ahead and change this to months. And what did I say? What month was it? 118 or something like that?
118.
Yeah. So I won't start paying off houses. We'll wait till year 10 to do it, until we've acquired everything, and then we'll end this in month 480, and we'll rerun this puppy and see what happens. Hopefully, it'll run pretty quickly, and we'll be able to go look at it. While it's loading, though, I'll wait. So, do you have any other questions while we're waiting for this to rerun, and then we'll go look at those charts again?
I've got so many questions. I don't open a can of worms. I guess just And a question I have for you, James, because I know you've been building this and also running a lot of scenarios for yourself to test it. You've been running scenarios for clients up in Fort Collins. You've been running scenarios for the weekly class you teach up there. What's been the most interesting thing you realized between running scenarios as far as like maximizing cash flow or buying? The general most interesting thing you've seen from running all these different scenarios? Or
Yeah, it's actually that's a good question, because we did a class, must have been 3 weeks ago or so now. My son came to me. He just started a job in Wisconsin. He came to me right before he started his job, and he said, "Hey, Dad, I want to talk to you about retiring early." And so I said, "Hey, I happen to know a lot about that. I study it all the time. You know, your mom and I can actually retire early if we wanted to. And so I'm happy to kind of run some math and show you what it takes in order for you to retire early." So I started running basically all the different combinations of ways for him to be able to retire early for himself. And one of the interesting things that came out of that class, because we did, investing in stocks, investing in bonds, buying nomad properties, buying 20% down properties, paying off houses early, recasting loans, doing, a whole bunch of different stuff. And one of the interesting things that came out of that is sometimes buying fewer houses will get you to functional retirement earlier. You get to the point where your cash flow improves enough where you can hit your minimum number, but it impacts how good of a lifestyle you have in retirement. Because if you had bought 10 properties, the amount of money you make in retirement is significantly higher, even though buying maybe 6 properties would get you there faster. So that was a pretty interesting thing to see.
And from, running that data, and I don't know if your son's looked at it yet, was he inclined to lean more towards one or the other?
I haven't talked to him about it. So I taught the class 3 weeks ago, so for Craig, and I recorded it for him. And I basically ran all the numbers and I taught it as a whole class. And then he did listen to the podcast and watch the video because he told me he did. But I won't see him until he comes home for the holidays, and we sit down and chat about like what he's thinking, because the choice is up to him really. And on almost all the paths, buying the first house is the same. So he doesn't need to make a decision about which one he's going with until 5 years from now or so, when he has to decide, am I going to go buy my 6th property or my 7th property, or am I just going to stop here? And I think you get to look at those numbers and make decisions as you go. The way I describe it to clients when we're talking about doing nomad is, you don't need to decide to do a 10 property nomad today. All you need to do is buy your first property. And then you've got a year to come to class. When I'm telling people, you come to class, you study all the books I've written, you study some of the things, you play around with the software, and you have a year to decide, James is crazy. I don't know what I was thinking. I'm not doing house number 2. Or, wow, this really still makes a lot of sense to me. I'm going to buy the second house. And then you got another year to figure it out again. So it's not like you need to commit to me to a 10-year plan. All you need to do is say, I'm going to buy a house. And then let's evaluate over the next year, and we can decide what we're going to do, and we can decide to buy a next house or say, nope, I'm done.
Yeah, and one of the things I like about that, you can stop at any time. If I get 3 and that's all I need, I don't have to buy 10, right? It's not like, I love what you said, James. You're not signing up for a contract that I've got to spend 10 years buying 10 more properties. I have a kid, or I need to move, or I get a new job, I can stop. And I've got 3 properties, which is still very powerful. And that's something that I say a lot, is think about your grandparents when they retired. If they would have had one free and clear cash flowing property, would that have made an impact in their retirement? And I'll bet it would have. And so it's not about having 10 or 20 or 50, maybe 1 or 2 or 3, whatever's right for you.
Yeah, I think that's totally true. All right, so this looks more encouraging now that we reran the scenario. So the red line now is the one with debt pay down, and we're comparing the red line to the blue line, which is basically doing the house hacking with roommates. So one is house hacking with roommates, the other one is house hacking with roommates and paying down loans faster. And you can see that the cash flow is very similar. The net worth number, I should say, is very similar to if we didn't have roommates, if you pay down your loans faster. If you're doing the ones where you're paying down loans, comparing it to just doing the roommates, it's about $5 million or so worse for you to pay down the loans as far as net worth goes. Now let's drill down into cash flow, because that's really what we want to look at. So let's see if this looks better. Cash flow. Oh yeah, much better.
There it is. There it is.
So basically this one shows you that you're getting your cash flow properties right here. this is when you stop buying those properties because you bought them all. In fact, let's go do that before we go look at cash flow, just to verify we've got the number of properties owned. So yeah, with these three, this was 20% down. The ones where you're buying the properties are like on top of each other. The blue and the red one, they're basically saying you're buying properties at the exact same rate. And so you're buying the same 10 properties at the same speed, even with the debt pay down, because we're not starting that until month 120. And then after that, we're starting to pay down the loan aggressively for that one. So let's take a look at cash flow. And so here it is. Your cash flow tends to improve over time here with this one. It's the same until you start paying off this loan, and then eventually you get to the point where you're paying off loans and it's bumping up and you're getting better and better cash flow on these properties. And then it stabilizes once you get to the point where you paid them all off, because then your cash flow is only increasing as rent appreciation happens. You no longer have any loans. You paid them all down. So you can see that on there. And the cash flow is significantly better here. By the time you get to month 248, your cash flow is $24,000 versus, $9,100 in the other model. Okay. Let's take a look at how quickly we get to goals. So paying down loans turns out to be better to achieving that goal. So you can actually retire earlier if you pay down your loans with that particular model. 157 months to achieve your goal versus 181 months if you don't.
It's pretty amazing. 2 years. 2 years difference.
Yeah, by paying them off.
Yeah.
You can see that in this chart here.
Can you zoom in on that?
Yeah, we can do
just right where they all kind of cross over the goals.
Yeah. Is that better?
Yeah. I just want to digest this. Huh. Yeah, when you start paying them down, that just goes vertical, huh?
Yeah, it really does.
Yeah, because you make big leaps in your cash flow. When the loan gets paid off, then it actually significantly improves it. Yeah. You see something else here. I'm going to go and look at just the one where you're doing the payoff, and I'm going to drill into the houses themselves and look at the mortgage balances. Mortgage balance. Yeah, so you're aggressively paying these puppies off with those loans. Yeah, you're making huge additional payments each month because you're basically taking all of that extra savings amount that you're doing that you were otherwise using to save up for down payments, and you're paying off the loans.
Mm-hmm. So there's a lot of different ways to do it, just depending on what's your risk tolerance. If you're comfortable having 10 loans for 30 years, or maybe you want to pay them off sooner, or that's what I really like about the software is, if you and I both did put in our exact same scenarios, James, I bet you they're going to be different. We probably have different preferences on that. And that's what I love about this. There's not one way to do it. I can show you this way. We can look at Chris's way. We can look at your way. Everybody that's on the call, we can look at the way they do it. Very, very cool.
Yeah, I agree. Yeah. So unless people have questions, that's all I really wanted to share with you today is kind of going over those 4 scenarios because we added an additional one on there.
Yeah. Are you able to grab the link, or is it the same link and just the next ID number on there, James?
That's a good point.
I might
so the link
that myself.
Yeah, the link here is it's just 313 for this one.
Okay, I will update that. So we will start closing out then as I'm grabbing this link, and I'll put that link in the webinar chat box. So a lot, as you guys can see, this is kind of like the end of our third part of our 3-part webinar series, and it's not going to be last that we see the software, hopefully anyway, James. Anyway, I just wanted to, the reason we did this was for myself to learn, for Joe to learn. And I actually used a software for the very first time myself, like actually in detail, building up my own scenarios. I taught a class last night on using real estate to retire. So I took a couple of cash flowing condos that we buy down here in Denver, plugged them in here, and it has really interesting results. So the plan going forward is that we're going to be using this a lot more to just run different models, run different scenarios on whether you're house hacking or nomading or buying rental properties or buying nicer rental properties, in-state, out-of-state, like all the stuff we talk about all the time. We got a brand new tool to start using. So you're going to be seeing a lot more of this. And I'll keep you guys up to date as to what I'm doing on here, what Joe and I are doing, what James is doing as well. James has got a lot of stuff going on with this software. So definitely keep you guys up to date on this. And of course, if you guys want to go in there and create your own account, it's realestatefinancialplanner.com. It's a free account, just have to register. And I'll also go in here and put the links to the 3 scenarios that we did for the past 3 webinars. So if you got any questions on these scenarios, reach out to me initially. I'll kind of take the questions and field them and try my best to answer, and then loop in James as needed. But James, I mean, just thank you so much. Any just like final parting words you want to talk about in the software, or kind of what your plans are with it?
I plan on continuing to develop it. That's really what it is. So, but yeah, no real final comments. Just just continue to work on improving it over time.
Awesome. All right. Well, everyone, I appreciate you guys watching and listening to this. Joe and James, thank you guys for coming out.
Yeah, thank you, James. This is great information. Really appreciate it.
Yeah, you're very, very welcome.
All right, everyone. Have a great one.
Thank you. Bye-bye for now.
Thanks, James.
Dude, that shit is crazy.
Yeah, that's cool.